Get an LLC. See how this year goes. If the year goes really well, if you're going to benefit from S-Corporation, your CPA gives you that number, they will retroactively activate S-Corp as of when you started.
If you guys are just getting started in this business and you own rental properties, do not put these business activities in that same structure, that same LLC. Keep it separated so no one gets confused. You don't get in trouble.
If you could do double closing, I would always do double closing because it really helps you really simplify your accounting and your bookkeeping.
All right, everybody, welcome back to the Real Estate Investing Podcast. I'm your host, Ron Apke, joined today by our accountant. He's been doing work for us for, I don't know, probably 4 years, Ashish Acharya. Sorry if I said that wrong. Welcome to the show, though.
Perfect. Hey, thank you. And you said it perfectly, actually.
Awesome. That's good to hear. And I have a lot of questions as far as like from the community. There's obviously a lot that goes into, and we're going to talk today, guys, about one thing is taxes and land flipping, and the other thing is like tax planning. Like, how do we minimize our tax liability at the end of the year? There's so many changes also that are coming. But let's just start from the beginning. Someone who is looking to get into this business, Ashish, should they get an LLC? Should they just do this from their personal bank account? What are your kind of suggestions for someone who literally they're getting into this? Maybe they're like, some people are like, I'm deciding to buy a course. I'm waiting to get my LLC all set up. I don't want to pay for your course until this. Let's just start from the very beginning, that first kind of tax decision.
Perfect. This is actually, if we're talking about a rental side of the real estate, I would say LLC do not matter. LLCs do not matter. Just go ahead and create them and don't worry about them. But if you're doing any kind of non-passive activities, just like flipping a land or wholesaling, okay, either you're hosting land or houses, doesn't really matter. Being a real estate agent, those kind of activities, land flipping, so the benefit does come from an S corporation once you hit certain mark, and it's different for everyone. That's where you need to work with your CPA to figure out at which point you might want to have an S corporation. For someone who has never had any other income, and if they hit, let's say another couple hits $50,000, then you might need an S corp. But if you already have a W2 job and if you're already making $200,000, then the threshold might go to 80. So again, not going to go through the numbers, but what you need to ask your CPAs and your accountants are this: when am I going to benefit from being an S corp? But remember though, when you're starting out, if you do not have an LLC since the beginning, then you can retroactively convert that LLC to an S corp to save taxes. But if you never started with LLC, let's say you flipped three lands and you made 40 grand, and you thought, I don't need S corp. And by the end of the year, you did really well and you did $200,000 of flipping. Then there's no way for you to get an S corp and save almost 25 grand in that $200,000 of self-employment tax if you don't have an LLC since the beginning. So the very basic answer for right now is, anyone who's just starting this, I would get a single member LLC. If you do not happen to make big, and if you're just learning and paying for courses, then you can still, you don't have to elect an S corporation. There's no tax impact. And getting a single member LLC, with you, doesn't impact your taxes. There's no separate tax filing requirement. It doesn't complicate stuff. But if you wait to save taxes, then having an LLC since the beginning helps you save taxes. Now, I want to tell you one thing. Very simple way for everyone to understand this without complicating is, do you need an LLC to pay for the land investing online courses? No, you don't. Okay, you never need LLC for any expenses. But let's say you happen to pay for the course and then you get LLC after 2 or 3 weeks after you're confident, then you can always put that expense in the LLC by reimbursement. Again, your bookkeeper, your accountant can help you with that. So LLCs do not stop you, but once you get serious about flipping, then get an LLC even before you do one flip, because it helps you convert to an S corp at the end, once it's required.
So you don't want to be making money essentially without an LLC, but you can put expenses, and then that could theoretically be rolled over into like an S corp. If so you buy a course, you buy coaching right now, 3 weeks later you have an LLC. And what I don't want to see is that so many people look for ways to delay taking action. You know what I mean? Whether it's I have people who take 3 weeks to decide on their company name for land flipping. I don't care. Like, you can make it flipping company LLC, whatever it is. So many people but that makes a lot of sense. So you guys are looking to get started, like don't necessarily, a lot of people want to wait for their credit cards so they can get those points, everything like that. Let's take one step forward. Do they just get an LLC in their state? What are your thoughts on that? What are the advantages? Everyone talks about Wyoming, all the Nevada, I think. What should they do in terms of that when they are getting an LLC? Where should they get one?
So remember, your operation, the entity that wherever you live, you're always going to get LLC in that state. I'm not talking about a holding structure where you get a holding LLC that holds in this S corporations we're talking about. You can get that structure. I can walk you through that complicated structure. Do you need that right now? No. You can always get that and convert, and change the ownership. No big deal. Remember, if you try to start getting this complicated structure since the beginning, not only you're not going to start, it's going to hinder you from starting, like even paying for the courses. So simple single member LLC in the state you live in, register there and start flipping land. Now, if you end up flipping a land in, let's say, another state, like you live in North Carolina and you start flipping in Georgia, then if you're going to do more and more of those transactions, then it's from legal perspective, it's good to register the LLC in Georgia for legal protection. If something happens there, someone sues you there, you don't have LLC there. It doesn't really protect you in Georgia. Okay, against the legal thing, it's not even tax thing. From tax perspective, as soon as you hit certain threshold of revenue in that state, you will be required to file taxes in that state, and then you're gonna and you don't have to register LLC, but from legal perspective, you want to register in the LLC. You're doing business in the state, right? But from tax perspective, you always have to file, even with or without LLC. You're always going to file some kind of taxes depending on the threshold in every state you're going to flip the land. So what we need to do is this. If you think about LLC in which state, first action item is create an LLC in your state, register it, do it correctly, so you're legally protected in the state you're starting out. If you happen to flip a land in another state, it takes like $50 to register one LLC in another state. That's all you need to do. So why not do that? And then if you have no income in that state, let's say something happens, the deal falls apart, you don't even have to file the tax return. It's always a good idea to register your LLCs in other states if you're going to do business there. But it's not required when you start out. And don't go through those holding company structure right when you start. But as you get into it, it's a good idea to talk to an accountant and CPAs and attorneys to protect you from legalities eventually.
Yeah. That's really important, I think, when you go into different states, like what is your strategy? And you're just talking about foreign entity, just registering as a foreign entity in those other states. Is that correct?
Yeah, as a foreign entity, correct.
Let's move on to like the actual land flipping, because actually before we do that, let's back up a step because I don't want to miss this, because a lot of people own rental properties, and we've talked and we've done 2 other interviews with you on the podcast, but we talk a lot about not putting land flipping businesses in the same LLC as holding businesses. Can you talk about that, the risk? And I think you had a scenario once where someone lost multiple 6 figures maybe.
Yeah, I'm glad you asked that, because people don't get into this flipping because they think they need LLC to even continue. And like I said, if you're just starting out, flip first land and then get LLC. It's totally fine, because unless the first land is going to make you $200,000, $100,000, then I'm sure you're already going to get LLC anyway, right? But you're only making 10 grand, 15 grand. It's okay. Don't worry about it. It's to not stop you from starting out. Now, when you're starting out, though, this is what I'm saying. Why should you not have a same activity, same LLC for 2 different activities? Meaning, when I say 2 different activities, I'm talking about even holding a land for investment. Sometimes you do that, and then holding a rental properties or any kind of other assets you do. Don't put in the entity that you're going to flip, land or building or whatever you do. And here's a very simple reason is this. When you convert this LLC to an S-Corp, which you will as you get into making more money, the properties I hold into this LLC for long term hurts you. Meaning, you go to the bank and you get, let's say your property has this, you say you have rental properties in this land flipping in business. You go to the bank to refinance the product and take the money out. Normally, refinance is non-taxable. However, if you put this in an S-Corp, you go to the bank, you refinance, you have a $500,000 equity, you take that out, If you go home and take the money out of the S-Corp to buy a vehicle, live your life, vacation, taxable income. I've client, I have some prospect come to me and cry on the call, and then I think it was like $700,000 of extra tax they had to pay, which goes completely not even cash, no tax. They had like 300, I think 3 million or something, a refinance of commercial properties in S-Corp. Refinance, they hit got with $700,000 extra tax. That's like a retirement money they could have avoided with right entity. So I know I'm saying a lot of complicated stuff. All I want you to understand, and everyone who is listening to this, is if you're going to start flipping properties, flip in this LLC, get LLC. If you're going to buy and hold anything, you can put in your personal name. You don't even need LLC for rental properties for tax savings. The LLC only helps you from tax saving standpoint if you're flipping something, if you're doing wholesaling, if you're a real estate agent, like non-passive income, if you have Amazon store, if you have food truck, rental real estate, investment, you never need LLC for tax savings anyway, so why put it in an LLC? Get on the LLC or put it in a personal name to start with. And again, always talk to a CPA, an attorney to have the right legal entities and liability protection. But if you're not talking to them, the simple strategy is don't combine non-passive and investment activities, which is passive, which is rental real estate. Don't combine them in one LLC. It's going to hurt you in the long run.
Wow. I always tell people this, and I always obviously say like this isn't advice, but that being said, I never knew the exact reason. I know we've talked about this scenario in the past, but that makes a lot of sense as far as like you cannot refinance essentially if you're in a flip, if it's a flipping or you can't refinance if it's an S-Corp. You can, but you get taxed if it's an S-Corp.
Yeah,
is that correct?
refinance, and people refinance to use the money, right? You refinance, take the money out, taxable. That's one reason. Other reason is if you have a rental property, you're going to do cost segregation, no tax savings. You know how people buy real estate, do cost segregation to save taxes, right? If you put that in S-Corp, literally it negates the cost segregation benefit. So all the benefits from real estate, appreciation, they get taxable. And this refund, the cost segregation saves to no taxes. There are a bunch of other reasons which I haven't even discussed. These are two big reasons. Cost segregation doesn't save you taxes. Refinance and you take the money out is taxable. Few reasons. There are others as well, but the bottom line is no S-Corp for your long-term whole assets, like even land, building, your jewelry, anything you think of. Don't put it under. Under S corporation, an entity that you're going to flip the land.
That makes a lot of sense. Yeah. So if you guys are just getting started in this business and you own rental properties, do not put these business activities in that same structure, that same LLC where you have rental properties. That is like the number one thing. Like, don't use that credit card. I don't think you would use that credit card. Like, just separate it. Keep it separated so no one gets confused. You don't get in trouble, anything like that. Because, yeah, that wouldn't be fun. $700,000 of it's not like it's just lost. Like 700, you just lost because of the structure, which is absolutely crazy. Let's talk about the actual activity of flipping land, flipping real estate, whatever it is, because a lot of people ask about short-term capital gains, long-term capital gains. Like none of that matters when you are flipping, from my understanding. You can obviously confirm that. And a lot of that, like, it's not like if you put it into that LLC that is a flipping LLC and you hold it for 14 months, it's not long-term capital gains, correct? But let's talk about like the inventory aspect of this business, how that works.
Perfect. You hit the nail over there. A lot of people go into this and say, okay, I'm going to hold this for 1 year and pay long-term capital gain. Flipping, even if you hold for 5 years, does not qualify for capital gain. This is why the structuring is so important. If you're gonna remember, you're in business of both flipping and you also invest on your own lands, keep it separate. The business activity needs to have separate books, maybe on a separate LLC or in a personal name versus LLC. Because when IRS audits you and they see you have this activity in the same LLC where you're flipping 100 properties a year, but you have some other lands, you argue that it's for investment. They're not gonna say that's correct. Your main business is flipping. We're not gonna because you haven't separated the activities. So it's okay to flip and also hold the whole land. Keep it separate and keep it as two separate business. One is pure investment in different LLC. Have a separate bookkeeping. Have a if you separate LLC, that's fine. But in a personal name. And the flipping is separate. That way, the land you've been holding, right? And you can also strategize. They say you really wanted to flip this land, but you're going to hold it for 2 years because of laws and permit and stuff, and put it on the investment one. Because now you can pay capital gain on the on the income you're going to make versus ordinary, which is 37% versus 15%, right? So you can strategize if you keep it separate, even though your intention was always to flip, because you also have investment business. That's one of the strategies. But to answer your question, long-term rental, long-term, even your long-term hold land, if you are in business of flipping, and if you have one LLC, you're never separated, it's always going to be an ordinary income tax, which is very high, and especially flipping. And on top of that, there's a 15% self-employment tax that you could avoid with S-Corp, but you want to pay 37% state plus 15% self-employment tax. That's 50% even without state. Think about how high that's why you need to have right entity, right CPA to work with, and they can clarify that for you. No big deal. Now, the other question you asked was, how does all these, how can you avoid, is it possible to even pay long-term capital gain? Is basically what I said before. If you if you have bunch of inventory already piling up, and you're not going to sell this for 2 years because of market, of whatever reason, create another business plan, investment business plan for yourself. Put all the lands they're going to hold long term in that. Act like, and also put the actual land you're going to hold for 5 years, 10 years. Okay, make a separate business plan so you can manipulate the tax rate. Meaning, you already have a business, you're holding few lands for 5-6 years already. Put this one land that you're going to sell it for 11 months, or sorry, let's say 13 months. Put it there and sell it. You can sell after 13 months and pay capital gain tax there versus ordinary income here, which again, it can be huge difference, by the way. So that's how you're going to manage capital gain versus ordinary income tax in a flipping business, and you need to understand that.
Yeah, that's really important, guys. And yeah, if you know you're going to hold land long term, and like she said, if it's 24 months, you don't overlap that in your flipping business, because I mean, it's a 20% difference in taxes. Like you said, if it's 37% versus 15, very, very important. Or if it's a market, like some people see, it's like, their intent, like you said, might be to flip, but they're like, this market is just skyrocketing. I want to hold it for 24 months. Put it into an investment LLC so you can get those long-term capital gains, opposed to being taxed on income. Because that's what flipping is, correct? Flipping is income. Flipping's like, if you have an engineering job and you're flipping land, you make $110,000 engineering job, $200,000 flipping land, you're being taxed on $310,000 of income. Is there any difference? Like, obviously, if you have S-Corp, there's things you can reduce your liability, but is there any difference?
Even worse, like, if you have W-2 income, you pay something called FICA tax. If you look at a paycheck, every Social Security and Medicare, it gets taken out. That's what the self-employment tax, but you only pay half of it. So if you make let's say you make $160,000, the FICA tax you're paying right now, okay, which is going to be 7% of that, because the employer pays half of that. If you start flipping and if you make 160 grand on your own, you're going to pay entire 15%. In $160,000, we're talking about $25,000 of extra tax you didn't even account for. It's not an income tax. Okay, so yes, that's why you need to know when to convert this to an S corporation. Your threshold can be different depending on your income level. What can you do? Is it gets stacked up, like you said. You make W-2. On top of that, you make this income. You're already in the highest tax bracket plus self-employment tax. How can you separate? How can you make this better? Is the biggest thing is, I'm not gonna lie, S-Corp, first thing, right? And second thing is, if you're already flipping land, you probably qualify as real estate professional. You see your spouse gets involved, if she's a housewife or in a housemaker, or if your spouse is a husband, whatever it is, right? One of you do this full time, then you can start investing in real estate and long-term rentals, which you're probably going to do anyway as you make more money, because as you get wealthy, you invest in real estate. It's a no-brainer. When that happens, then you can wipe out your entire taxes with rental real estate. That's cost segregation, everything we're talking about. And that also then ties to what we're talking about. Now, if you get an S-Corp and put this rental in S-Corp, cost segregation is not going to have benefit. So I know, so we need to talk about so many aspects, and it touches everything. But to answer, and it's the same concept, but get right entity. Don't put everything together. Separate them out. If you have a long-term asset, you're going to hold it. Separate that into different LLC, and then now, last thing that we're talking about is, if you happen to do this full time, or if your spouse is a housewife, and if he or she is you want to get involved in real estate, they should. The reason is, once they get involved in real estate, you qualify as a real estate professional, then anything you buy, long-term, strip mall, apartment building, long-term rentals, even short-term rentals, can really wipe out your taxes, like 100%. I'm talking about 100% wiping out your taxes. You could say, I have clients, I was doing, a webinar this morning with another client, and I think he saved $200,000 by doing exactly what I'm talking about. $200,000 of taxes that was saved because of what I just talked about. So very powerful, but it again, I know if someone is beginner, don't go there yet. Talk to your CPA; they will plan it for you. But beginning starting point that what Ron was saying earlier is this: don't mix stuff. That's going to ruin everything else in the future. So keep it separate, and you'll be and then talk to your CPAs as you make more money. And as you make more money, you have more cash to talk to your planners. You can spend money to talk to your tax planner because they will save you $100,000 and you might pay them $5,000. They're selling you $100 bill for $5. Buy it.
Once you start making money, then you can afford to cease.
Exactly. Ron, I'm building this tax planning software, which is going to basically do what people pay us $10,000. You're going to do it for $1,000 going forward, probably next year. So people, they're going to benefit, and obviously you'll test it out too, and you'll see that. Okay.
I can't wait. That's exciting for sure. So backing up, and I just want to make sure we walk through this. So guys, when you first are getting started, if you're creating an LLC, don't overlap, like we said. The S-Corp thing can come down the line. The S-Corp thing does not have to be like you could make 2025. Let's say you start an LLC today. You could make $500,000 and never really say you're an S-Corp until December when you're like, okay, I've made a ton of money. And then what you have to do with an S-Corp, Ashish, until you have to pay a fair and reasonable salary to yourself. Can we talk about that a little bit? So someone who maybe it's, April, and they've already made $150,000 this year. They're like, I don't know what they're talking about. But like we can save a lot of money. Maybe they're projected to make 600 grand. They do have to go through payroll. That's the thing with S-Corp. When you start going as an S-Corp, you can save a ton of money. But that being said, you do have to run payroll. Is that correct?
That's very correct. And this is how we would approach it. And it's a good thing. This is the first year beginning. You're going to get an S corporation. We know that. You already have LLC. You're already flipping land. Remember, you're going to talk to your accountant and CPA, and they will tell you, okay, this is how much salary you're going to pay yourself to have optimal tax savings. Because remember, you're going to make $600,000. Most of the CPAs will tell you pay as less as possible. Don't do that because you're going to miss out on something called QBI deduction, which is 20% deduction. So you have to optimize your salary. And I know, we go through this user module, but I don't want to walk through numbers right now. But all I'm saying is this: yes, you need to pay salary, but the good news is this: you can wait until November to see how this year goes and run one big payroll from the S-Corp you're going to create. And that's what I was talking to you about earlier. Get an LLC. Don't even need an S corporation, until November. See how this year goes. If the year goes really well, if you're going to benefit from S corporation, your CPA gives you that number. Okay, you're going to benefit from S corp. They will retroactively activate S corp as of when you started. This is January or February. Then you can pay a salary in November, October, once that is determined that you've saved money. So, and then you can pay a salary. So you got time to determine that. So you don't have to stress about it, but you do have to run the payroll before December to reduce the audit risk. Because if you don't run a payroll for an S-Corp, then, they don't like that. First year, they will slide it. They will say this is the first year, you can catch up next year, but especially if you're in year 2, year 3, you have to run a payroll. And then your CPA will tell you how much though. That's the caveat. Don't just run the lowest amount. Don't go read on the internet and say pay the least amount. That actually hurts you. I've seen clients pay $30,000 in payroll. And not me when I say this, Ron. A client, makes $1 million as a broker, and the accountant say, hey, pay as less as possible, and they were paying like 60 grand something. He was losing out on, I think, 80 grand of tax savings just because they were not paying the optimal payroll. So and we made him pay $260,000, and he actually saved 80 grand more. So wow. All I'm saying is your CPA will run that for you. Okay, don't try to do this on your own. It's complicated. Just understand, don't go and run the lowest amount. It's going to hurt you. I just want to let you know, everyone know that.
So is that something like to maximize as far as savings and I'm kind of thinking this for myself, honestly, right now, would you kind of just have it, let's say you already made money for it, you're already an S-Corp, everything like that, and then you pay yourself $50,000 for the first 11 months of the year, and then you talk to Ashish, you talk to a CPA who knows what they're talking about with this stuff, and they're like, you got to pay yourself another $100,000 in December to maximize that. Is that the best strategy? Like where, and then the whole year is going to say you paid yourself $150,000 W-2.
Yeah, that's totally fine. And the good news is this too. And this also comes from tax, like cash flow management. And you hit the point. Let's say you are expected to make, you're expected to run an S corporation by the end of the year. You're just waiting for a few things to fall into places. You can take the money out of your S corporation to live a life. You take out in $10,000 every single month or $20,000 every single month. That's fine. When you go to November, we can reclassify that money taking out as a payroll. So you don't have to have that much cash in your bank account to run a payroll again of another $200,000. Let's say you already took out everything you could possibly take out from your business bank account. You only have 50 grand left over. Now I'm telling you, run 50 grand, $200,000 of payroll. The good news is we can recharacterize the whatever you already paid throughout the year, some of them as a payroll, and you only need to have enough cash to pay taxes, like withholding. So yes. So see, everything I'm talking about is good news, especially since we're in April and you're listening to this. If you can talk to a CPA right now, they'll give you a right path by the end until the end of the year. Even if you talk to them in August, September, even October, you'll still be fine. Just have that LLC in place. That's the biggest thing. I've keep talking. And the LLC in place, and everything will fall into places.
Ever wondered how land investing can be the fastest path to financial freedom? I break it all down in my new book, One Lot at a Time. I'll show you exactly how to find, buy, and flip land for huge profits without dealing with houses, tenants, or any crazy renovations. It's simple. This is the book that I wish I had when I first started. If you're ready to take control of your financial future, grab a copy now. One Lot at a Time by Daniel Apke. Find it at your local bookstore or on Amazon.com.
That makes a lot of sense. Yeah, this stuff and I'm not the best with it. I know you've been on us. Like, you guys got to minimize your tax liability. You guys are always on us, Daniel and I, in terms of buying rental properties or something. And we always kind of we've done some syndication, stuff like that. But syndications, you're not going to get the same tax savings as if you are the actual one running it. But let's go into, okay, so this is going to be basic. So someone, end of the year, they've made $500,000 flipping land, and they say, all right, I'm going to buy $500,000 of land. I'm not going to have to pay any taxes next year. Tell me how that is incorrect. A lot of people think it's an expense.
I know. Just think, and I think I give this example every single time. Think about Walmart. Walmart goes, buys, $1 million of milk to put it on the shelves. It does not create the expense for them. It's an inventory. They haven't sold it yet. Unless you take that milk and sell it, then you can expense your cost. That offsets your income. But unless and until you sell it, it's not an expense. Unlike, let's say you buy a printer for $5,000, it's an expense for the business. You can write it off right away because you're not reselling it. But anything you buy, you create to resell, or buy to resell, you cannot just expense it. Otherwise, and remember, it's from common sense. Think about this. Walmart makes $1 billion in December 29th, and now they don't have to pay taxes. They could go and buy $1 billion of milk on December 31st and pay zero taxes because you know what? I just bought, which they're gonna sell it very next day on in 7 days on expiry. They can manipulate tax if they do not have the inventory. That's why the IRS is like, no, this is an accounting issue. If you buy inventory, you cannot expense it unless you sell it. Same with land. Let's say you make $1 million you have $1 million cash in your bank account. Now you feel like, oh, you know what? I'm going to pay so much taxes. I'm going to go spend entire $1 million and buy $1 million worth of my land. So I'm going to sell it in a very next month in January. $1 million of income and expense is not expense. It's an asset. It sits a balance sheet. It doesn't go to your income statement, meaning that you still have $1 million income even though you expense it on an asset you bought.
And that's what a lot of people find themselves in because it's just, and Daniel and I probably the first couple of years had some issues with it because we were spending all of our capital. Like, all right, I don't want to get funding for this. I don't want to do all this. And then your tax bill or your tax liability is more than what you have in the bank because all your money's in land. And from my perspective, guys, I see so many people run into this, especially their first, second year. They're very aggressive. They're making a lot of money. but they have less money in the bank than their tax because all their money is in land, which is not any tax savings or anything like that. I'm sure you've probably seen people maybe who own a bunch, I don't know, probably not rental properties, but flipping's probably a very common one where they don't have any money for their taxes because all their money's in houses or land or whatever it is.
Exactly. Very common problem. So you need to understand. If you understand this rule, then you will set aside money. Honestly, this is what I recommend to people. If you have $1 million, if you really want to save, say you have this $1 million we just talked about. You made $1 million income. Now you want to save taxes. How are you going to do it? This is how you're going to do it, guys. Take that $1 million, go buy a rental property. Buy in cash, $1 million. Spend it. Do cost segregation and try to save some taxes at that $1 million. Now go to the bank, very next few days a week. Take 80% out of that $1 million, right? And then you have cash now again buy inventory. That's how you do it. That's how we do it, because rental property you just bought could save you in that $1 million could save you literally $100,000 in taxes. Versus if you just go buy a land and tie that money in the land, it saves you nothing. So think about using your cash in a better way for tax planning. Buy real estate, long-term rentals, short-term rentals, apartment building, and then take the money out if needed, or you just buy it, put a down payment and buy it, and preserve your cash rather than trying to tie up an inventory.
Mm-hmm. That makes a lot of sense. Especially when you guys start making that much money, like this needs to be, and getting deal funding also, like don't put that, like you got to stop revolving and just continually put your earnings into the next deal. A couple of reasons is, one, it feels like you're broke. I remember when Daniel and I, like the money we were making, I looked at bank account, like it doesn't feel like we're making anything because it's always in the next deal. And beyond just the tax thing, like from a mental, like it doesn't feel like you're making any money because you buy a property for $50,000, sell it for $80,000, then you buy an $80,000 property. So you don't have money. Are you growing equity? Absolutely. Or kind of potential for sure. Someone asked the question, and then I got a lot of questions from our community. Are you familiar with double closing first off?
Yeah.
Okay, so with double closing, any different tax implications, or is it just the same thing? Like you're flipping, even though you only take title for 6 minutes, whatever it is, same thing.
Same thing. I mean, normally this is how double flipping works. Double closing works. It happens in real estate and land equally, right? When a closing table it simplifies your accounting. You only recognize income of the money you made in between the double closing as your commission, versus trying to buy a land, put in a balance sheet as an inventory, and then trying to sell it and get the entire income, like let's say $500,000, and writing off the cost of it, let's say $400,000, and making it $100,000. Accounting is simplified. Now, if you could do double closing, I would always do double closing because it really helps you really simplify your accounting and your bookkeeping. Meaning, no difference at all. I mean, it's same. The money you make by double closing or buying land and selling yourself, same tax treatment, nothing different. Double closing actually helps you less paperwork and just get it done out of the way, less inventory, less upkeep, and less risk. Obviously, right? You're selling right away anyway.
Mm-hmm. That makes sense. So let's go back to the end of the year. So end of the year, we said we can't just buy a bunch of land. That's not allowed. Like that, you can go for it, but there's not going to be any tax savings on it.
Yeah.
What are some end of year things? Can you pay for a year? Like, can you pay for 2026 for a full software on December 30th or something like that? Like an annual plan, marketing materials. Those are kind of what I'm thinking. And we're only in April, so people are going to forget this. But that being said, what are some like end of year tax savings? Not like buying real estate and all that. What are some end of year like expenses people can put stuff on?
If you're not buying anything to resell, you can spend anything. Like you can buy a vehicle. Let's say you want to buy a $100,000 truck, right? To use a business, buy it. If you want to buy anything, you can buy it. Other than what you're going to resell is expensible. Just so you know. Meaning, even if you buy at least $100,000 vehicle, it could be written off. I mean, they're talking about bringing back 100% bonus depreciation. So you can write off entire thing. Even if you don't, let's say even if they don't bring back, you can write off bonus depreciation, 40% of that. And there's another 30% of Section 179. You could write off $50,000 vehicle. Yeah.
For the business.
Anything you're not selling, you can buy it and you expense it at the year end. Marketing material, your rents, let's say you rent an office space, pay the entire next 12 months of rent. you can expense it. Those are prepaid expenses. You can expense it if you're going to use it within 12 months. If you're going to use it within 12 months, you can. But you cannot go and pay 5 years worth of rent and then expense it this year against the same issues as inventory. But there's exception, 1 year. If you're going to use it within 1 year, you can write it off.
Yearly subscription to the land portal. Asis's tax software once that's up and running.
Exactly.
All those things pay for a year thing. That I didn't know that it's up to a year. That makes a lot of sense as far as doing that. And those are things that like some softwares, like some people are spent marketing materials. Like so, if you're like buying a lot of people right now, Asis, are doing home mailers. So like you said, like the $5,000 printer, a bunch of envelopes, all that stuff. As long as you use it in a year. And again, that's something that I'm learning there, which is very cool. That's very interesting. So what about anything with credit cards that people need to know? So someone asked, obviously we talked about when to get an LLC, but like using 0% credit cards from the start, people who understand the risk of that, that's just all expenses, right?
And the good thing about LLCs, credit card is this. Let's say you have a $5,000 cash or $10,000 cash and you need to buy a printer, you pay that cash, but you actually lost the cash. But credit card, you can put it in a credit card. You have a month to pay, or you have 12 months depending on 0% interest. You can expense it right away. So if you spend $100,000 on credit card a year in, even though you have a 0% tax rate, interest rate, you're not going to pay it for next 2 years, like 24-month, let's say 24-month promotion period. You can still expense it. That's a loophole. So credit card, anything you spend with credit card can be written off right away, even though you don't have even though you don't have to pay it right away. That's a good thing. But the cash purchase, you're going to lose cash, obvious, right? So that's not a good thing. So if you want to preserve some money to get a tax benefit, put it on a credit card at the year end. It helps you.
You said before we hit record on this, you wanted to talk about seller financing. And this, again, is something that I'm sure I'll have follow-up questions because this is something that I just learned before. Implications, seller financing, vacant land, seller financing, land with improvements. Yeah. What are the differences?
First, I want everyone to understand seller financing, and this is how it works. Like, let's say you bought a land for $500,000, very nice land, and then you want to go and sell the land for $1 million. That's a $500,000 gain. If you had just sold it outright like normal people do, you get that $500,000 cash. So and then if you owe any taxes, you can take the money and pay taxes. When you do seller financing, what happens is the seller is going to say, "I'm not going to put any down payment. I'm going to pay you in the next 5 years." People do that. They'll sell the land under that. If you do so, you get no money. Like you got no money. You're going to get the money over the next 5 years. So you get taxed. You're supposed to get taxed slowly. Whatever payment they make every year, let's say they only pay $50,000 a year, you only get taxed on $50,000. That's how seller financing works. It works on most of the investment assets. It never, even if you do seller financing in flipping properties, like if you flip a house and you sell under seller financing, people get confused and get screwed. Their seller financing got no cash, but their gain was $1 million. They have to pay like $400,000 cash in taxes, which they never have right now. Never sell flipping, especially houses, on seller financing. If you do, understand, you're going to have some phantom income. You're going to pay taxes right now, and later you don't have to pay taxes. It's just
is that total value of the note essentially is what you're paying? So buy for $500. Let's say you buy a house for $500,000, sell a note on the house that's worth 1.1. You are getting taxed immediately on $600,000 of profit.
Yeah, gain. Yeah, exactly. Even though you're not going to get any money. Now, How does that work for land flipping? If you're going to buy a land and you're going to sell it right away in seller financing, there's exception to that. Thank God. Okay, that's why if you're going to buy a land and flip it, but you sell under seller financing, there's exception saying, okay, you can do seller financing, you don't have to pay taxes right away. However, if you start plotting the land, or if you start improving the land and sell it, then you're screwed. Then it doesn't apply. So to maintain that exception, do not improve the land. Meaning don't add a water supply and plot it and sell it separately. And don't do that. Don't try to be a builder and developer.
So if you don't improve it, let's just say you buy a piece of land for $100,000 and you get a down payment of $20,000 and the note is worth $200,000. Are you taxed at all since you're not above what you put into it? Or is that's not an expense, like, correct? As far as like if you sell it and you only have $20,000 that came back, the note value might be worth $200,000. Can you talk about that a little bit?
Yeah. So just to put a number here, let's say your cost is $100,000. You sell it for $300,000. Your gain is $200,000, right? You bought it for $100,000. You sold it for $300,000. So your gain, when you sell it outright, you're supposed to have a gain of $200,000. But the seller said, you know what? I'm not going to pay you upright. I'm going to pay you only 20 grand upfront and $180,000. What I owe you, or whatever they owe you, and it's going to be 280, but it's on the loan. They only pay you $20,000, and remaining $280,000 on the loan. What you get taxed on is only the 20 grand, and not even 20 grand. How much was the gain? It was 66%. So only 66% of the $20,000 get taxed. So that's why it's going to get complicated. All you need to understand is this: whatever down payment you get, only portion of that is a capital gain. So you don't have to pay tax on the entire note. That's a good thing. That's exception. Normally does not apply for flipping properties, but it has been lobbied, and then that's why they get an exception. Exception was if you're flipping a land, then it's okay. You can do seller financing, but if you're flipping a house, though, it does not work. So be careful when you're flipping a house.
But you are still over your head in terms of you had $100,000 out, you got $20,000 back, and you're still taxed on that $20,000, and you still have $80,000 that you're kind of like you don't have.
Exactly.
Okay, that makes sense. That is definitely advanced, I think, in terms of that. Let's kind of finish this out with. We talked a decent amount about tax savings with S-Corp and stuff like that. And I haven't thought about solo 401k or anything like that in so long because you can't do that with employees. So someone who's making $100,000 this year, let's not talk about buying rental properties. You talked about buying a car. Let's talk about some little tax saving things for someone who is an S-Corp. They want to do an S-Corp. They made $100,000 this year. Definitely paying yourself the salary that a CPA suggests. But what are other little things like solo 401k? I forget even what that's called, that people can do.
Okay. Remember what everyone should be doing is don't miss out on basic tax savings. Don't miss out on your expenses. Don't miss out on your, things you're going to spend on your subscription. Always get your expenses right. Right? That's the first thing. But there are things that people normally wouldn't do, but you should if you really want to save taxes, especially you're already in higher tax bracket, and then you're making another 100 grand on top of your $500,000 W2 income, your spouse's income. You're already in 37% tax bracket, even without state. And then on top of that, there is 15% tax. So what should you be doing besides making sure you do not miss out on the expenses is this. I'm talking about big ticket items here, okay? Retirement accounts, depending on which one, SEP or solo 401ks, you can hire your spouse and pay her salary and then do a retirement account for her as well. Don't hire your kids, pay them 1099. That's another thing, right? Pay your kids 1099. If you hire your kids, then you lose solo 401k. 1099, if you hire your kids. Okay, when I say hire, contract your kids, hire your spouse, solo 401k, buy a vehicle. Those four things could wipe out almost, I'm not kidding, $100,000, $200,000 income, to be honest with you. Okay? And small thing, I'm not going to go and write off your $50 meal. I hope you're already doing that. Even if you do, it's not going to make a huge difference. Big ticket items, like, a home office is one of the big thing. And if you have a home office, make sure you're writing off home office. And then a vehicle, kids, 401ks, spouse. That would really bring you down, really be down on your taxable income if you could implement those 4 or 5 biggest strategies. Mm-hmm. I'm not going to go about Augusta rule and making all this all the things, because this comes with admin headache and might not save you as much, right? So go with this first. But now as we start making more money, Ron, I'll tell you a few things that really good people do is. And this also applies to you, Ron. I want to make sure I bring this forward to you. Now, as you start making more money, our goal should be how to think like a rich wealthy people, because Trump is not out there, and I'm not very political, but I'm giving just an investor example. Trump is not out there trying to do a short-term rental loophole and buying a short-term rental to save taxes. He's not out there trying to qualify as real estate professional to save get rep status and write off his income. What he's doing is this, and you're already there, Ron. You need to be passive in your business. You need to Ben run the business for you. You need to have your CEOs run it and CFOs run the business for you. Meaning, you just do a podcast and then take your financials and market done. Don't get into operation. Why? Here's the reason. You have multiple businesses, you make it passive, or make the biggest cash flowing business passive. You make $1 million from them. Then go buy investment properties without getting involved, like fully outsourced property management property, right? Now, both of them are passive. Beginners, what they do is they have W-2, they have non-passive land flipping, and they want to convert their rental to non-passive with reps and short-term rental and offset. Wealthy people, what they do is rental is always passive. They don't want to do management of their rental properties. They want to be passive real estate investor to make money, which they do, but they convert their business to passive. Now, this you don't have to try anything. Now you can do save margaritas in the beach and save taxes. That's what the rich wealthy people do. Steps on your tax planning. Beginning, yes, you're gonna be like you did, cost segregations and rep status and short-term rental. But as you make more money, which a lot of flippers do, you want to be passive in your business. You need to systemize it. You need to have a high VAs and employees run the business for you. Move out. And then one big thing you mentioned earlier, I want to mention this. If you have an employee, yes, you cannot do solo 401ks and maximize that. So what you're going to do is you're going to be a director in your business and then have another entity by yourself. You're going to pay yourself management fee, no employees. That's where you're going to run your solo 401ks, okay? And that happens once you start getting bigger. I'm not going to go there, but there are ways you can talk about it, how to manage that. So much information, man. This course always goes with complicated information.
When do you suggest, and take off your CPA hat, when do you suggest, like, some people are so concerned about taxes right when they start and everything like that? Is there a dollar amount, like, where they need to start thinking about? Because I tell a lot of people, like, all right, do 5-10 deals, and then we can talk about that, think about that, make 6 figures, whatever, in this business. But like, so many people are so like concerned about just wasting mental energy on stuff like, you got to do some more deals and make some more money. Do you have an opinion on that, or do you think someone should always be thinking about taxes?
Yes. There are two group of people that happens. If you have no other business, you're trying to get this is not your side hustle, you're doing this full time, and you don't know the income, then I would not say number of deals, because one deal can make you $1 million sometimes. So dollar threshold, get up to 40-50 grand, and then you can really think, okay, I need to now save taxes with spouse, hiring kids, all this thing. 40-50 grand, don't even go think about taxes before 40-50 grand if you're not going to make more than 40-50 grand. First year, you can have your land course investing and expenses. You're going to have your software, your marketing, your printers, and your even if you make 80-70 grand, it might drop down to 40 grand anyway. So don't think about taxes as soon as you start doing and stressing it out. But the other group of people is your spouse is already making $500,000 and you're doing this on the side gig, then you're already in that 37% tax bracket. Even though 50 grand is going to tax at 37%, if you make 100 grand, it's going to tax a higher tax bracket. Then your threshold to worry about taxes comes sooner. So talk to your CPA. And hopefully, if you already have you're making $500,000 to your W-2, hopefully you already have a CPA, and you're already going to take care by the nature of your involvement and your financial decisions. But a good thing about the people who have no income and they're trying to turn around their life with this gig, then by nature, you're not going to have a CPA. It's okay. Wait until 50, 60 grand, 70 grand, and then talk to a CPA. And I think it works out naturally that way. But don't wait until you're going to make 150 grand. Or if you know you're going to close on a big deal, go talk to a CPA. Email me. I help out people out for free anyway. Just email me and I'll help you out. I'll guide you. And I have so many people reach out from your group, and I have never charged them. I just give them the entity structure. Go implement this. Don't need to work with me right now unless you make money. I've done that. So I'm giving you to your community. Email me. You send my website. You send my stuff. Kensley can do that. They can direct email me. I give them free stuff. I talk to them anyway. I'm offering that to your listeners here.
What's your website? Where can people find you and more information?
If you just Google investor friendly CPA, you will see a bunch of stuff. But investorfriendlycpa.com. There's a free link. You can schedule a call. info@investorfriendlycpa, clients at investorfriendlycpa, updates at investor. Whatever email, you can put my name, Ashish at investorfriendlycpa, and directly email me. We'll get back to you. We're very responsive.
We'll put the URL in the description below. And one thing I love about working with Ashish is like his business has grown so much since we started working with him. He's not ignorant and as far as like where AI is going to be with this stuff. And that's why he's building a software to help with this. Like some people are in businesses. ChatGPT is my main doctor. Some people are in businesses where they like fight it, but it's coming whether you like it or not. And Ashish is ahead of the curve on that. So that's one thing that I love. Anything else you want to add there, Ashish?
You like this, Ron. I right now as I'm speaking, we entirely changed our platforms. Like proposal system, the proposal we gave you is going to be so much smoother. You see, it's clear. The client request you're going to see. We entirely practice management because of the exact reason you told about AI stuff. We are converting our business to a whole different platform. Our tax planning software is going to be there. Anyone who wants to do their own tax planning going forward is going to have AI-based, comprehensive, real estate focused software. It's called taxmd.com. It's like webmd.com. It's going to be amazing. You guys will see this. If you follow us on social media, you'll see the update where you're gonna once that launches. But before that, it's up to me. I'll answer your questions.
taxmd.com. Did you pay for that URL or do you have to buy that from someone? Huh?
15 grand. 15 grand.
15 or 50?
15.
15. Wow. Yeah, I assumed, but I mean, that's a good one to have, and it's early to have that for sure. But Ashish, I really appreciate you. Like I said, guys, I'll put links to get in touch with him, to get in touch with his team. It's a great team to work with. Don't overthink it. If you're just getting started, you don't need to schedule a call right now. We had tips the first 10 minutes of this episode. Other than that, guys, hit the subscribe button below if you're watching on YouTube. Share this with a friend. Thank you so much, Ashish.
Hey, thank you, Ron.